Hi, everybody. I'm Natalie Brunell, and thanks so much for checking out my show where I get to hear from the leading voices in Bitcoin, financial markets, political structures, philosophy, and more. Please make sure that you subscribe to my page and like this video so more people see it and so that you don't miss out on any new content. This podcast does not provide financial advice. It is for entertainment and educational purposes only. This show wouldn't be possible without support from my sponsors. First and foremost, Swan Bitcoin. Swan is where I do all of my Bitcoin purchases, and I dollar cost average every single day with the lowest fees in the space. And I love Swan because it's a Bitcoin only company. Swan Studios produces my new show, Hard Money, covering the biggest news in Bitcoin and the global economy. It's like an orange-pilled version of CNBC. So make sure to check that out on YouTube for all the biggest headlines because we are not afraid to question the mainstream narrative. And Swan is putting on the first and biggest West Coast Bitcoin only conference, Pacific Bitcoin. It'll be held November 10th and 11th in the LA area with prominent speakers like Lynn Alden and Preston Pish. I'm very excited to be the MC for the event alongside Peter McCormick and Stefan Livera. So if you want to get your ticket with 20% off, use the code HODL at pacificbitcoin.com. All right, it's time for the show. All right, Peter, so nice to see you. How are you doing? I know you had a hurricane come by, right?
Yeah, it almost hit us. But of course, the power was out all over the island because the infrastructure is so poor here. The power goes out all the time anyway, but we got a lot of rain. Some parts of the island got some flooding, and so that really did a number on the antiquated power grid that the Puerto Rican government created for us and just neglected over the years. So yeah, that's one of the negatives about Puerto Rico. You have to make your own power, and then you have to worry about running out of diesel fuel. Mm-hmm. So that was also a problem. And of course, there was a big tanker off the coast of Puerto Rico that wanted to dock here and give us diesel. But of course, it wasn't a Jones Act ship, and the Biden administration didn't grant the waiver. So unfortunately, we had to just go without the diesel.
Yeah, no, I heard you talking about that on your podcast and wanting the Biden administration to repeal that. Obviously, I don't think that's going to happen. But all right, let's get into it because what you really talk about on your podcast the most is the volatility, everything that's happening in the markets. You wrote a book a couple of years ago that I love, The Real Crash. And it sounds like you think the real crash is finally maybe upon us. So why don't you give us an update, maybe 30,000 degree or 30,000 feet up high view? What is the macro environment right now?
Well, first of all, it was more than a few years ago. I think that was back in 2013. So, we've kicked the can down the road for a long time. But the real crash that I wrote about, and the title of that book came about because the crash that I wrote about in my 2007 book, Crash Proof, a lot of people thought the crash we had in 2008 was what I was writing about. No, I predicted that crash. That was part of it, but it wasn't what I really was worried about. What I really was worried about is what hasn't even happened yet. And that's why I wrote the second book. It's just surprising me now looking back that it's taking so long for this to play out. But I always knew that the problem was the government had unleashed this massive inflation tsunami. I just didn't know, when it was going to hit. I thought it would have hit sooner. But they did QE1, QE2, QE3. They printed all this money. We had massive budget deficits. We created a mountain of inflation. But nobody cared about the inflation because all they did is look at the CPI and they said, well, it's not going up more than 2%. And part of the reason for that was the way they rigged the numbers. It really was going up more than 2%, but it wasn't going up 10%. Maybe it was going up 4 or 5%, but they could fudge it enough to make it look like it was going up less than 2%. But after we kicked the, monetary, heroin into a massive overdose after COVID, right? We just went crazy with the money printing, and we sent everybody home and had people not work. I mean, that really brought everything to a head. And so now we're experiencing the consequence of the inflation I've been warning about for more than a decade. And this is just the tip of the iceberg. It's going to get a lot worse. The 8%, 8.5% year-over-year inflation that we've seen is going to go much higher. The Fed is not going to be able to fight inflation. It spent the last 10 years or more creating inflation. And there's no way they're going to get rid of it, not unless they're willing to allow a much worse financial crisis than the one we had in 2008. Not unless they're willing to allow a far greater recession than the Great Recession we had in 2008, 2009. And in order for us to get rid of inflation, the government is going to have to get rid of the budget deficits because they've been paid for with inflation. So we have to have massive cuts to government spending and maybe big increases in taxes, not on the rich, but on the middle class. On average, Americans are going to have to pay much higher taxes because government has been paid for through inflation. And if we're going to find another way to pay for government other than inflation, well, then it's going to have to be another form of taxation. And so I don't really see the Federal Reserve having the guts to stick to the inflation fight. I don't see the U.S. government, having the integrity to make the type of spending cuts or tax increases that would be necessary. So we're just going to have inflation. And the markets don't understand that, but we're going to have double-digit inflation as a way of life in America. It's just going to continue for year after year after year. And there's really no relief in sight. And then I do think at some point, the bond market's going to collapse. We'll have a sovereign debt crisis and a currency crisis as our creditors realize that the dollar's a bottomless pit. But, in the short run, we had this big sucker rally in the dollar. Maybe it just ended. We're having a big update. Gold's up, $30, $35 today. Silver's up $1.50. So we're starting to see people question the Fed's resolve in fighting inflation now that we saw the Bank of England pivot. And now we're looking at potential bailouts of UBS in Switzerland. And some investors are starting to think, wait a minute, if the British couldn't handle it, if some European banks are going to fail with higher rates, what about American banks? We're not immune to this, and we're not. If the Fed raises interest rates the way it's claiming, everything is going to implode. And now people are realizing that the Fed may not allow that to happen. And so the dollar is going to implode instead.
Well, I want to come back to some of those points about the sovereign debt crisis, as well as what happened with the Bank of England. But first, you mentioned your prediction of double-digit inflation. A couple of other analysts that I've spoken with, they have the same thoughts. But right now we are seeing, CPI come down, housing slow, lagging indicators like unemployment, which is going to continue to tick up. So how are we going to get from maybe CPI coming down lower before the underlying forces of inflation really take off and we get to those double digits?
Yeah, well, when you see the dollar roll over, remember, we've had these big increases in consumer prices with a huge increase in the value of the dollar relative to the euro and yen and other currencies. And so that's really mitigated how much prices have gone up. And so when the dollar reverses, that's going to push prices up much higher. So the temporary drop we saw in oil prices, that's going to reverse. Other prices that pulled back when the dollar was strong are going to rise when the dollar weakens. Because remember, the strength of the dollar was based on the false perception that the Fed could actually win a fight against inflation and was prepared to do what it took to win that fight. But of course, the people who thought the Fed was going to beat inflation are the same people that thought there was no inflation. They said inflation wasn't a problem, and then they said it was transitory, and then they said, oh, don't worry, the Fed's going to fix it with a few rate hikes. It's not going to work. The rate hikes won't be effective because they're not enough. The Fed has to get interest rates above the rate of inflation. And so if inflation is 8%, they got to go to 10%. They have no chance of getting anywhere near 10%. They won't even get to 5. They probably won't even get to 4 without a collapse. And you also have to have the big cuts to government spending. And right now, government is increasing spending. Nobody is talking about reducing government spending. All they're talking about is new ways to spend more money, and that creates even more inflation. And so, yes, we got a little bit of a dip because, nothing goes in a straight line. Everything ebbs and flows. So we'll have a little bit of a pullback in the headline inflation numbers, and maybe some people will be lulled into a false sense of confidence. But then inflation is going to take off again. Think about how many times last year they kept saying peak inflation, peak inflation. Every time, it went down a little bit, they were celebrating that it was over. And then, of course, then we'd have a new number and make a new high. But we're nowhere near the peak. We're near the trough. That's how bad this is.
Are you watching the liquidity in the Treasury markets? Like, what are you looking for as signs that something is breaking that will spark the Fed to maybe pivot or at least pause?
Well, it's already happened, right? It already happened in the UK. I mean, you saw what happened with the pension funds that were heavily levered in the bond market and were exposed. You know, U.S. pension funds, insurance companies, everybody has levered bond portfolios, but the whole country is exposed here. The whole country has been living off of cheap money. That's been the secret to this phony recovery, has been debt and inflation. We've built an entire economy based on debt and inflation. Now the inflation is the problem, and you can't just, turn that off. You can't have a foundation of debt and inflation and then build a whole phony economy on top of it and then take away the debt and inflation and not expect the whole thing to come crashing down. It can't levitate in midair. And think about all of the companies that have been financed with debt that would have gone out of business years ago or never would have started up, but for the flow of cheap money coming out of the Federal Reserve. You take that away and, everything implodes and, the jobs go along with it. But we've had tremendous malinvestments over the last decade or more when interest rates have been artificially low. We haven't saved enough. We haven't invested enough in real plant and equipment. All we've done is spent borrowed money, and we've speculated. We've funded all kinds of crazy ideas. One of them, unfortunately, is what you're into, cryptocurrencies and Bitcoin. I mean, all this stuff is malinvestment. All these companies that are in the crypto space, they're all going bankrupt. You just told me you're headed out to Europe. You're going to all these conferences. You're going to conferences. All of this is a complete malinvestment. All of it is going to implode. It is all nothing. It is all part of the bubble. There's all kinds of tech companies too that are going to be imploding because we weren't doing what we were supposed to do, thanks to the Fed and other central banks and governments. The whole economy is screwed up. And when you start to raise interest rates, all of that becomes apparent. You start to see all the problems. It's, the hangover from all the drugs. But, the Fed does not have the stomach for that. Just like they bailed everybody out in 2008, just like they did it again in 2020. They're going to do it again, whether it's 2022 or 2023. But this time it won't work because I think this time it'll be fatal for the dollar. That's why it's, the overdose on stimulus, because you end up killing the dollar. And then it's a sovereign debt crisis. And then nobody can get bailed out because when it's the US dollar and sovereign debt, maybe not even just US debt, it could be European debt, Japanese debt, all this debt comes into question because nobody wants to own it. Because the reality is the public can't pay with taxes. And so it's either default or inflation. Those are the only two choices that governments have. And either way, bondholders are going to lose.
Well, you're touching on something really important because you're right. We can't even have the real crash that would wash out the malinvestment because we always have this backstop and the Fed always ends up coming in to print. And how many more times can they do that is really the question. You're saying this will be the last one. So how does that play out? Because right now, when something does break, they're going to rush in and save it, just like the Bank of England had to step in and basically reverse everything that they said about their aggressive hawkish stance. So do you think that we have maybe, a period of a couple more months where we chop along? The sell-off has arguably been pretty orderly to a point. Do you think that just at some point we have a capitulation and then bam, the money printer goes boom, and that's the last time that we have this sort of massive bailout?
Well, I think when the Fed has to do another about face and the balance sheet, goes up again, when the Fed goes back to quantitative easing, everybody is going to have to know by then. I would have thought they'd have figured it out already, but sometimes you need a safe to drop on your head. And I think people will know that, there's never going to be a shrinking of the balance sheet. The balance sheet is going to grow forever. And inflation is going to be a problem forever. And now the markets have to readjust to that. You could live with high inflation. It's not good. You could adapt. They did it in Argentina and other countries, right, where you just have high inflation all the time. The markets find a way of adapting to it. But the politicians do not have the political will to do something about it because, again, they've been financing their spending with inflation. That's how they pay for all these deficits. We print money, we destroy the value of money, and prices go up. That's just the reality. And I don't see Congress willing to do what's necessary and the Fed do what's necessary. Now, maybe if we have a real crisis, I mean, if we start to see, the dollar imploding and interest rates soaring, long-term interest rates, and, we start to see a complete meltdown of society as a result of, shortages and price controls or power outages, that whatever's going to happen, and people rioting in the streets. I don't know, maybe they'll do the right thing then. I don't know, but they tend to delay doing the right thing for as long as they possibly can, and so it could get pretty bad between now and that inflection point. But I think if you just look at what's already happening, a lot of the signs are there. On one of my recent podcasts, I talked about how the fact that everybody says they don't ring a bell, they never ring a bell at a major top or a bottom. And, my experience is they ring a lot of bells. People just don't know what to listen for. They don't hear them. And I said, what happened in England? That was like, Great Ben, a massive bell went off there because the Bank of England broke. And, maybe they're the first domino to go, but all the central banks are in the same predicament. And interest rates go up, and it's not just a shallow recession; it's a depression. And the problem isn't raising interest rates. That's not the problem. That exposes the problem. The problem was lowering interest rates in the first place and leaving them there so long and allowing all this debt to build up, allowing all the malinvestments and the misallocation of resources, because now we have this gigantic mess that needs to be cleaned up, and it's not going to be cleaned up pretty. There's going to be a lot of losses. Investors are going to lose a lot of money. Average Americans, people are going to lose jobs. The free market has to do this to fix what the government screwed up. But it's not the free market that you want to blame. Blame the government. Blame the central banks. They created the problem. The only way to solve it is with the free market. It's the government constantly preventing the free market from solving the problem. That's why the problem is now so big. It's like, forest fires. You have fires, and if you have enough fires, then you don't have a really big one. But if you don't have any of those small fires, then eventually you get a much bigger one. Or, same thing with earthquakes. I mean, you have a bunch of little earthquakes, and then you don't have the big earthquake. You release some of the stress from the fault or whatever. But, the Federal Reserve never allows any of these recessions to run their course. They never allow the market to really purge the economy of the excesses, get rid of the companies that need to fail so we can make room for those that need to succeed. Instead, the government just bails everybody out, props up companies that should fail, replaces one bubble with a bigger bubble, and the economy never really heals. And so now, we're going to have, 10 on the Richter scale kind of economic earthquake as a result of these imbalances that have built up because government has stopped it. And what's amazing is that so many so-called experts, in academia, on Wall Street, and government, they still don't get it. Like the reason that I knew the 2008 financial crisis was coming is because I understood the mistakes that were made that led to the bubble that made that crisis inevitable. Well, all the people that were laughing at me in 2006, 2007, that had no idea what was about to happen, they're the same guys that are just as clueless today. They don't understand that everything the Fed has done since the 2008 financial crisis was a mistake, as they were, complimenting them. Ben Bernanke was the hero. He was on the cover of magazines. He saved us. He didn't save us. He's the reason that we're in so much trouble. Him, and then Janet Yellen, and the policies that they pursued instead of pursuing free market sound money policies. We inflated these giant bubbles, and now we're at the point where we can't do it anymore because now the consequences of the inflation have become a problem. So now inflation is the problem. Well, how do you stop that? Well, you got to remove all the cheap money. But then now the day of reckoning that we refused to deal with in 2008, that we refused to deal with in 2020, now we've got to deal with it. But it's way worse. It would have been much better had we followed my advice in 2008 and just let the crisis run its course. No tarps, no bailouts. Whatever banks failed, they failed. If people lost money, they lost money. Let the foreclosures go through. It would have been much better to have sucked it up and bitten the bullet in 2008 than have to endure where we're headed now. It's way worse.
Well, Peter, we disagree on Bitcoin, but we agree on so much of what you said. I completely agree with everything that you're saying. In fact, I recently interviewed Senator Cynthia Lummis from Wyoming, and she said when she was working in Congress that Ben Bernanke at one point was asked, at what point is our debt too high or unsustainable? And he said, I don't know, but we're not there yet. And then subsequently, she heard multiple Fed chairmen say the same thing. I don't know, but we're not there yet. So, I mean, is there a way for us to keep kicking the can down the road? And what does that look like? Because arguably we should have had the real crash that you talked about in your book, but we haven't yet. So how can we keep kicking the can down the road? Can you play that scenario out?
Well, the way we kicked the can down the road is we kept interest rates at zero. And so even though we had a massive amount of debt, it wasn't that expensive. In fact, even Janet Yellen last year, she said the amount of debt wasn't important. What matters is what it costs to service it. And she said with really low interest rates, we don't have to worry about the debt. Okay, well, what happens when interest rates go up? Like they're going up right now. All of a sudden, you have to worry about the debt. But remember, Ben Bernanke said a lot of things that turned out not to be true, including that subprime was contained and we didn't have to worry about it. But of course, when in 2009, when Bernanke was up on Capitol Hill, and one of the congressmen said, you're monetizing the debt, right? This is what banana republics do. Yes. Ben Bernanke says, no, we're not monetizing the debt because this QE program is temporary. We're going to sell all these bonds. And so it's not really debt monetization. Debt monetization is when a central bank buys bonds and then they stay on the balance sheet. Mm-hmm. Well, they're still on the balance sheet. We have almost a $9 trillion balance sheet. I said in real time that Bernanke was lying. I said there's no way these bonds are never going to get sold because once the government buys them, they can't sell them because who's going to buy them from the government? The only reason rates are so low is because the government bought all those bonds. The minute the government tries to sell those bonds, rates are going to soar. The reason they bought them was because we can't afford the high rates. But so how can they sell them? Because now there's even more debt. Look, that's why I called it a monetary roach motel. I said that from day one. I said, because once they check us in, it's impossible to check out. That's why I said we'd have more QEs than Rocky movies back then when we had QE1. And now we've had 4, and we're about to have the 5th round, right? And I think they had Rocky. I don't know if they had Rocky 6. I know they had Rocky 5. But the thing about the Rocky movies is they got worse as each subsequent Rocky movie was worse, right? The first one was a great movie, and then they kind of started going downhill. And so that's what's going to happen with quantitative easing. Not that the first one was good either. The first one was bad, but they're just going to keep getting worse. But the next one is going to be even bigger than the first 4 combined. And remember, when they finished QE3 and they said, okay, we'll never do it again, my prediction was that QE4 would be bigger than 1, 2, and 3 combined, and I was right. Mm-hmm. And QE5 will be bigger than the first ones. But then the dollar just implodes. It can't survive that. But unfortunately, Bitcoin's going down with it. I don't know. I feel really bad for you because I've got you're thinking right about economics. You kind of understand that, and I see some of your talks, and yeah, you've got that down. You understand the Austrian economic angle. You know what the mistakes are.
That's right.
But you're fixated on Bitcoin. Bitcoin is another mistake. You got to understand that there's no substance there. It's not gold. It's not digital gold. Why do you think Bitcoin is still at 19,000? Despite all the money that was spent hyping it up in 2021, despite that run up to near 70,000, look where it is. Why do you think the Grayscale Bitcoin Trust that used to be at a 30% premium is at a 35% discount? Do you really think institutions are adopting Bitcoin when they're trying to unload it and that fund is trading at a 35% discount? The fund is down 80% from its peak. Is that a store of value? Is that a safe haven? No, it's not. Bitcoin is a highly speculative asset, but what the hell are you speculating on? Because there's nothing there. There's no fundamentals there. You're just speculating on a greater fool. That is not what you want to do. If you're really worried about the monetary problems and inflation, and you're looking for a store of value and a safe haven, you don't have to reinvent the wheel. You've already got one. You've got real money. You've got gold. You've got silver. You've got monetary metals that you can own, and you've got other assets that you can own to protect you from inflation. You will get no protection from inflation in Bitcoin or any of these cryptos. All you're going to do, if you buy Bitcoin right now, all you're doing is helping somebody else get rid of their Bitcoin. The winner in that transaction is the seller. The loser is the buyer. And the biggest loser is whoever buys the most and gets caught holding the bag.
Well, you know, it's crazy, Peter. 73% of the Bitcoin supply hasn't moved in the last year. So people are still holding on to this asset. I'm one of them. I think Spencer might be another. But before we start to wrap up, I want to ask you a little bit about the Bank of England, because you touched on it and crystallized it in such a simple way on your podcast. And a lot of my listeners, they're kind of, general backgrounds. They might not really understand how the pension system uses leverage. Can you talk a little bit about how we got to that point with the British pound where we saw that crash and what the pension funds were doing, and maybe how that could happen potentially here in the US?
Well, it will happen. There's a lot of even bond funds that have done this trade. But look, the British pension system, you have government regulations, labor laws, and they say, here's how much pension money you have to provide. And here's how much the workers are contributing, right? So you know how much you're going to get in contributions, and then you have these benefits that you have to pay. And so the pension companies have to, manage their assets to try to meet those liabilities. Well, a lot of the pension funds, not just in the UK, but everywhere, they invest in bonds, because bonds, you have an idea of what you're going to get, right? Stocks, you don't really know. Stocks, they can go down, but if you have a bond and you're getting paid a coupon, you know what the interest is going to be, and you can use that interest income to cover the pension obligation. So let's say interest rates went from 6% you were getting on your bonds down to 3%, right, on longer term bonds. So all of a sudden your income is cut in half, but you still have all the same pension obligations. Now, you can do two things. You can tell all the workers, hey, you got to contribute more money now into your pension because interest rates are down and we can't make the same return, so we need higher contributions. Or you can say, look, we got to cut your pension benefits. We can't earn as much money. But they weren't doing that because of the law in the UK. They weren't allowed to do that. So in order to try to maintain the amount of income, they went and borrowed money and bought extra bonds. And they could do that because the short rates were dirt cheap. Let's say they can borrow at 0.25% or 0.5% and then take that money and buy bonds yielding 3%. They just created income out of thin air, and now they can keep on paying their pensions. But what happens is interest rates really start to go up, bond prices start to fall, they get margin calls, right? Now they're upside down. There's going to be a real crisis in the pension fund market, and that's why the Bank of England came in and started buying all those bonds. And in one day, the yield on a 30-year British gilt went from like 5% to 4% just in one day. And I think the yield has gone down more since, but the bonds were in free fall. And of course, part of that was accelerated by two very stupid political moves that were made in the UK. One was a cap on energy prices, like price fixing. Yep. And that would just mean that the British government would have to spend a lot of money buying energy for people because, if they just let the price go up, then people would use less. But if they keep the price artificially low, people want to buy more. And so now the government's going to have to pay for it. So that was going to send these budget deficits that were already at record highs higher. And then they decided to cut taxes, right? Rather than cutting spending, which they needed to, they cut taxes. Well, where are they going to get the money? They didn't cut spending. So that's bigger budget deficits. So this was all, snowballing. And so the Bank of England just turned tail and ran. Instead of saying, well, we're going to keep fighting inflation, and so you're going to have to deal with this mess, they turned around. And I think the Fed is going to make the same decision. I don't think Powell and the rest of the FOMC have any more backbone than the Bank of England. I don't think they're going to tell the U.S. government, deal with this crisis. We're fighting inflation. We don't care if there's another financial crisis. We don't care if big banks fail. We don't care if pension funds fail. We don't care if insurance companies fail. We don't care how many American voters lose money. We're fighting inflation. Leave us alone. You know, we're independent. I don't think that's going to happen. I think they're going to do what they've done every time before, is they're going to try to rescue everybody with the magic of their printing press. Well, we're all going to find out that it really wasn't a trick. All they did was create inflation. They never did anything productive. They kicked the can down the road, and the illusion won't work this time. It's just they've done it too many times. The problem is now too big, and everything is going to collapse. And you got to do something other than just owning Bitcoin. I mean, you can't just have your money in cryptocurrencies. The only thing is you're young. You're young. You got your whole life ahead of you. You can start over financially. You can get wiped out. But just in case you got some older people like me that might have been following your advice and they've got their retirement money in Bitcoin. Bitcoin is still close to 20,000, right? At 19,000 something. That's still a lot of money for nothing. And it's a lot better than getting nothing if you keep holding. You mentioned all these people that are still in their Bitcoin. Yeah, I mean, they're holding and hoping, right? That's the problem. And they think they've made money on the Bitcoin, but they haven't if they haven't sold. But, you know, there probably is a lot of loans. There are a lot of people that have borrowed money against their Bitcoin. And so they're going to have the same problem that pension funds have. Once Bitcoin, I think, cracks below 10,000, I think you're going to see a big problem with forced sales and margin liquidation from the people that went into debt to borrow Bitcoin. You know, that also includes Michael Saylor at MicroStrategy. MicroStrategy took on a lot of debt to buy Bitcoin. I mean, they're down over $1 billion on the Bitcoin they bought with borrowed money. So this is an accident waiting to happen. And all of this is going to, you know, weigh heavily on the price of Bitcoin and other cryptocurrencies.
All right, let's talk about Bitcoin 2023 and Bitcoin Amsterdam. Here's a look at Miami 2022, but Bitcoin Magazine and the team that brought you the world's largest Bitcoin conference is bringing the mission of hyper-Bitcoinization global with the inaugural European gathering this fall. Bitcoin Amsterdam will take place on October 12th through the 14th at a beautiful venue in the heart of the city. Join thousands of Bitcoiners for 3 days of curated Bitcoin content that is relevant to the emerging Bitcoin scene in Europe and the global movement. Confirmed speakers include Dr. Adam Back, Alex Gladstein, Greg Foss, Ray Youssef, and many, many more. The European installment of Sound Money Fest will also take place on day 3 of the event, October 14th, and admission is included with GA and Will passes. And after Bitcoin Amsterdam, which I'm so excited to attend, is of course Bitcoin 2023. It's going to be held again in Miami next May, and you can head to b.tc/conference. Use the code HODL, HODL, for 10% off your tickets to both BTC 2023 and Bitcoin Amsterdam. I will see you there. And finally, I want to thank my partner, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase with Fold's Bitcoin Cashback debit card and win free Satoshis every day, or even a whole Bitcoin by spinning the daily wheel and purchase rewards wheels. Fold app is one of the best ways for someone completely new to Bitcoin to enter the space and start earning and learning. You can head to foldapp.com/Natalie for 5,000 sats when you sign up. All right, back to the show. It's so funny, Peter. It's almost like you wish bad things on Bitcoin, because the reality is MicroStrategy is up 72% since they adopted the Bitcoin standard. 19,000 as a support level when everything is selling off. There's been stocks, the FANG, some of them have crashed more than Bitcoin is drawn down in this bear market. There are a lot of reasons to be optimistic, actually, as people learn about the technology network behind Bitcoin. Yeah. But I know you'll remain bearish. I know.
Natalie, MicroStrategy is down on the Bitcoin that they bought. That's reality.
Yeah, yes, a lot of us are.
Right. So they made a bad decision as an investment. Now, the stock price went up because a bunch of people bought the stock, and that's a bubble. And I mean, it's still down like 70% from its peak, right? A lot of people who bought MicroStrategy, I like what it got, to 900 or something like that. So there's a lot of people that have lost a lot of money on MicroStrategy. But yes, from the day they first bought Bitcoin, the stock is still up. Let's talk to me at the end of the year. I doubt it'll still be up. I think by the end of the year, MicroStrategy will be lower than the point that it first bought Bitcoin. Look at how much money El Salvador has already lost on their Bitcoin. I mean, they can't afford to lose money, and look how much they've already lost on it. And yes, Bitcoin has trended sideways ever since it crashed down below 20,000, but it hasn't rallied, right? There's a lot of selling around 20,000. And yes, there's still some people trying to buy it around that level as well. So you've got kind of a battle going on between the people that are trying to buy it, just below 20,000, and maybe the people who want to sell it above 20,000. But don't let that lull you into a false sense of security. Look at that chart. It looks horrible. There's a massive double top. There's a head and shoulders top. We've broken the trend line. We have got nothing but air. Once we take out that low from the big drop, which was probably around, I don't know, it was around 18,000 or 7, it went lower, then it rallied back. But the bottom is going to drop out of that market, just because it's temporarily stopped falling. Yeah, that's what bear markets do. They kind of trap you in there. They try to give you a false sense of hope that the lows are in, the bottom is in, and then we get another big leg. And, maybe we'll end up spending a lot of time around the 10,000 level, maybe a little bit below. And then maybe there'll be some people that are saying, aha, you see, here's the bottom here. And then, then it'll crack to 5,000 or 1,000. I don't know. And then at some point, it's just going to go down. But, the money is coming out. I mean, that's it. I mean, and the institutions are gone. They're not coming in. That was all just a scam to sucker in the public. I mean, yeah, there were a few institutions that went in, and look what happened to them. Look at Scaramucci's Highbridge. Look at their funds that they put all this money and they set up all these funds. These funds are down. Maybe their best one is down 60%. The worst one is down 80%. I mean, they've just lost a ton of money. They came in at the top. So any of these institutions that got suckered into this mania, they've lost a lot of money. And wait till the lawsuits start, Natalie. I mean, a lot of people are going to get sued. Look, the SEC just today, right, slapped a $1.2 million fine on Kim Kardashian. Yeah. But that's just the beginning. Look, Kim is nothing compared to what so many other people have been doing, pumping in Bitcoin. But it's not just the SEC. The lawyers are going to be out. The lawyers are going to be, look, you'll probably get sued yourself. I mean, everybody who has had any part in promoting Bitcoin, trust me, they're all going to get sued because so many people are going to lose so much money, and the lawyers are like sharks, right? They're going to look for class action, and people are going to be looking for someone to blame. This is going to be a complete shit show after this bubble implodes, right? And everybody's going to be pointing fingers. I mean, this is bigger than the dot-com bubble.
The SEC should absolutely go after these cryptos that are securities, and they will continue to. Kim Kardashian never promoted Bitcoin. It was a crypto security. So to be fair, and I agree with you on something else, actually. I do agree that Bitcoin could go down even lower. It is extremely liquid. Things are extremely volatile. I think there could be a capitulation moment. But I wanted to talk to you a little bit about the housing market, because I don't know if you know this, but a ton of people right now are Googling housing market crash. They think it's going to be similar to 2008, but the banks are not, they weren't making those kind of risky loans, at least not to retail home buyers. So
yes, they were. Yes, they were.
Okay, so talk to us about that. Could we see a worse crash for housing than 08, 09?
So the thing about housing, it's not just about how risky the loans were. It's about the rational decision that a homeowner will make when confronted with a mortgage that they really can't afford. And that has to do with how much equity they still have in their home, right? So if you have a lot of equity in your home and your mortgage payment really goes up, you don't want to lose your home. You don't want to lose all that equity. And so you'll struggle to make the payments. You'll cut back on other things, whatever you have to do. But if you look at what's happened with the mortgage market, the average down payment that has been made on a mortgage is 5%. That's it. So no one's been making 20% down payments. People have been putting 5% down. You sell a house, the realtor takes a 5% commission. So putting 5% down is like putting nothing down. Now, real estate prices, since the beginning of the pandemic, prices went up, 30, 40%. I mean, just some crazy amount. So anyone who bought a house at those levels, those home prices are unsustainable. And when they go down 10, 15, 20%, the people who have mortgages on those properties, if they were struggling to make those mortgage payments, even if they got a low rate, if they're struggling now because their food costs have gone up, their utilities have gone up, energy, insurance, tax, whatever. They may say, look, I paid 400 grand for this house. It's only worth 350,000. Well, screw it. I'm just mailing in the keys. Or I'm just going to, I'll live here until they kick me out. I'll just stop making my mortgage payments and let's see how many years it takes them to evict me, because it takes a long time. If you stop making your mortgage payment, you could live in that house for years before you have to leave. And you don't even have to pay your property taxes either. You just have to pay your electric bill, right? Because they'll turn off your electricity if you don't pay that. But you don't have to pay for your property taxes. You don't have to pay your mortgage. And, there's a lot of people that have home equity lines of credit that are going to be resetting. Believe it or not, there are people that took out adjustable rate mortgages. I mean, it's not like everybody took out a fixed rate mortgage. And so some of these people,
right,
3, 4, 5 years ago, took out an adjustable rate mortgage and their rate was 3% or 2%. And now all of a sudden it's 5 or 6%, and that's only because there were some caps, because the mortgage rates now are 6.5%, 7%, right now. But people are going to see their mortgage payments up 50%, 100%. I mean, chances are they can't pay. So this has been a huge asset bubble in real estate. There's nothing but leverage in real estate. Everybody buys real estate with borrowed money, basically. And so prices have to go down. Just because there weren't any subprime loans, a lot more than just subprime went bad. Subprime was just, the tip of the iceberg.
Yeah.
It was
the
weakest
snowflake
link in the chain.
that snowflake
I
started the
remember
avalanche.
when subprime first blew up, because we were short these bonds, but when subprime blew up and Ben Bernanke was like, oh, don't worry, it's contained to subprime. The reason I knew it wasn't contained is I said, no, this is a mortgage problem. It is not just a subprime problem. It's just that it's showing up in subprime first because it's the weak link in the chain, but the other links are going to crack too, because all these mortgages are going to be in trouble when rates go up. And I said, it's not just the subprime borrower who's going to make a rational decision to stop making mortgage payments when their house is worth less than their mortgage. And so people are going to have the same decision. That's why you're supposed to require a 20% down payment. You want to make sure that people have skin in the game, and also, maintaining a house is expensive. Stuff goes wrong. I mean, look at all the hurricanes. I mean, look at what happens, to people's homes. They're expensive. If you're a renter, it's your landlord that has to deal with that. But when you own the home, you got to deal with those problems. They're expensive. There are a lot of people bought homes that never should have bought homes. They got enticed into the market by cheap money and low down payments, and they really weren't financially responsible enough to buy homes. They bought them anyway. Mm-hmm. And so, so there's going to be a lot of defaults again. Again, the only way to stop it would be for the Fed to go back to QE, start buying up mortgages again, mm-hmm. cut interest rates, but that just fuels the inflation fire. Inflation is not going back down to 2%. I mean, we'll be at 20% before we're at 2%.
Well, Peter, so let's touch on that for a second, because you argue that the money printers are going to go burr again. I think a lot of us agree. What does that look like, though? Does that mean that all of a sudden interest rates drop back down and people are funneling money back into the growth stocks and the meme stocks, and the stock market goes, I don't know, S&P 6,000, a melt up? Like, what does this actually look like to you?
I don't think so. I think a high inflation environment is not going to be friendly to tech stocks. It's not going to be friendly to the meme stocks or the cryptocurrencies. I think you need low interest rates and low inflation for those trades to work. So I think high inflation and lower and loose money or lower interest rates, lower nominal rates, I think that's going to favor traditional value. So in the stock market, it's going to be, the old brick and mortar dividend paying companies, that people didn't care about during the bubble. Companies that have real earnings today, not potential earnings in the future, or no potential earnings in the future, like a Bitcoin. But companies that have earnings now, that can pay dividends now, and more importantly, they can raise their prices so they can raise their dividends, because people are going to need dividends that go up with the cost of living. So if that's where the money is going to flow, businesses that have pricing power, that have real assets, that can pay inflation adjusted yields that will give you a positive return. Now, I think, those stocks exist. I think most of them are outside the United States. That's what I've been buying for years. knowing what the end game was going to be, I've been accumulating these types of stocks, preparing for the environment that we're headed into. And I also think it's going to be a commodity boom. Raw materials, natural resources, metals, energy, agriculture, all this stuff is going to be what's going up, not, the tech. And so people have to reorient their portfolios to get into those sectors. I think the emerging markets are going to be primary beneficiaries of what is going to happen here. And most people have very little exposure or no exposure to those markets because they've done so poorly over the last decade during this mania. So I think everything that worked when we could pretend inflation was low, none of that's going to work in the reality of inflation being high.
Peter, I totally agree with you on that. I think that, commodities were on a downtrend and now they're going to see a bull market. And luckily, Bitcoin is a digital commodity, according to the SEC. So it might benefit from that. But I agree we had a cycle of 10 years of growth stocks. Now it's going to go shift back to value. And we have these cycles, but it's been interesting to see just the volatility. And I mentioned this earlier, Peter, but don't you think the sell-off has been rather orderly? We haven't had this massive, break in the system yet, even though things are so leveraged and we have so much debt to historic levels?
Yes. I mean, we haven't had a major crash. We've just had a slow, steady decline, although maybe not quite so slow. I mean, if you look at, where we are, we're, on pace to have one of the worst years in the stock market ever. Mm-hmm. We just had the worst September since September 2008. So it was, so it was a bad month. But no, we didn't have a Black Friday or Black Monday type event like we did in 1987 or a big crash like we had in 1929. But the Nasdaq is down or was down before this morning 35% from its peak. Mm-hmm. So it's still in a bear market, and we've lost all that ground this year. Remember, the Nasdaq hit its record high in January, and so did the S&P and the Dow. So it's been a pretty a bad year, and we had a big sell-off intra-quarter. We had a bear market rally in the beginning of the quarter. But if the Fed continues the pretense of fighting inflation, today's rally is going to be completely undone, and the markets are going to make new lows. I mean, the only chance the market has is if the Fed completely does a 180, but that's not going to save it. It's not going to go back to what worked before. I still think a lot of these tech stocks, like the ones that Kathy Wood owns and the ARC Innovation. I mean, these companies are not going to do well in this environment.
Peter, I think you've said in some of your writings before that raising interest rates is really allowing the fever to do its work, right? Because we've never really allowed for the excess to fully drain out. We can't. We always come in, we quantitative ease. So my last question to you is, I know you wouldn't want this position because you don't even think it should exist, but if you were Fed chair right now, if you were Jerome Powell, what would you do that would maybe soften the blow of everything that's happening right now?
Actually, we don't want to soften the blow. The blow, unfortunately, has to be harder, in the short run. The softening of the blow has been the problem. But what I would do is I would want to let the markets know that the Federal Reserve was no longer going to be in the price fixing business, that the Federal Reserve was not going to be raising interest rates. The Federal Reserve is going to sit back and let the market raise interest rates to whatever the market believes is the appropriate level. In the meantime, the Fed is going to be divesting itself of its portfolio of U.S. Treasuries and mortgage-backed securities. And that would be it. I mean, I would be out of this. I would start shrinking the money supply and let the interest rates go where they need to go. And they would go much, much higher, right? I mean, that's just what would happen. And then everything would implode. But in the long run, I think we should get rid of the Federal Reserve, or at a minimum, go back to the original Federal Reserve that was envisioned when they passed the Federal Reserve Act. In 1913, with the Federal Reserve the dollars were still backed 40% by gold, and they were redeemable 100% in gold. I mean, it was real money. It was legitimate currency. It was just issued by the Federal Reserve, but it was still backed by real dollars, gold, that were created by the U.S. Government. They minted the coins, and then all of those Federal Reserve notes, you could take them and you could get your gold. I mean, that was the whole purpose. I mean, they never would have created it as just an engine of fiat money.
Yeah. I mean, they were prohibited from buying government debt, right? Back then it was initially prohibited. Right.
Well, that was when they formed it, but they amended that during World War I. because now the government wanted to use the Federal Reserve to finance World War I, so they had to amend the Federal Reserve Act to enable them to hold government bonds. But when they envisioned the Federal Reserve, they specifically prohibited it from owning U.S. government bonds because they didn't want the U.S. government to be able to fund itself using the Federal Reserve. But of course, all of those protections, have gone away over time. So I would want to reinstall them to the extent that we have a central bank. But I don't think we need a central bank. I think we're better off without a central bank. I think even if you can argue for certain benefits of a central bank, it's not worth the risk. They're always going to exceed their limited mission. Power corrupts, and so you never want to empower a central bank. And I think with the technology we have today of the internet, we never have had less reason for a central bank. There's no reason that we can't go back to a gold standard without a central bank. Banks or private companies, you're into the technology, the internet, the blockchain. It's very easy for banks and other institutions to custody bars of gold and then create digital tokens, right? Tokenize that bar of gold and create currency, right? That is real money because it's backed by that gold, and everybody can negotiate with it. Everybody can use it as a unit of account, medium of exchange. It would be a store of value. We don't need central banks to print these pieces of paper so that we all have something we recognize. We don't need governments. We don't need central banks. We can create our own money, and we can digitize it so that gold will function as a much better medium of exchange and unit of account than it ever has over the past 5,000 years. People that always want to criticize, oh, well, I can't send gold to Australia. Yes, I can. I can send my ownership of gold to Australia. I can send you ownership of gold cheaper and faster than you can send me Bitcoin. And I'm sending you ownership of something real. So you're taking the monetary system and you're bringing it into the 21st century, and you can do it completely without government. We don't need governments to go back to a gold standard. We can do it on our own, and that's ultimately where we're headed.
Are you introducing a Peter coin backed by gold? This is your security?
Yeah, I mean, look, anybody could create them. It's not, but as long as, a cryptocurrency backed by gold would work. Right? A cryptocurrency backed by nothing doesn't work. That's just fiat. It's not. It doesn't do the job.
Someday, Peter, we will get you to fully understand Bitcoin. But okay,
no, I fully understand it now. The problem is you don't understand it. The people that own it are the ones that don't understand it. I've understood it since the beginning. Okay, see, if I didn't understand it, maybe I would have bought it and become a billionaire. But unfortunately, I'm going to become a billionaire the old-fashioned way. I'm going to earn it.
All right, last question, and I hope we don't take this in too dark of a direction. But you have kids. You have Spencer, who's bullish on Bitcoin, not gold. But
yeah, well, he's only 20, so people do foolish things when they're young.
Well, listen, I'm just kind of curious because with the direction that you're predicting, and a lot of us agree that the money printer is going to initiate once again, they're going to debase the currency. We'll have high double-digit inflation. I completely agree with a lot of the things that you're predicting because this path that we're on is unsustainable. Our debt is too high, and they've basically corrupted the power of the global reserve currency. So in that kind of world where power is continually getting more and more concentrated, and we have people looking for a political savior because they don't understand how the system works, they don't understand economics, and neither do either party, in my opinion. What does that world look like? Like, do you get worried for, Spencer growing up in a world that's increasingly divided and polarized where, now we're having global geopolitical conflicts come up, countries creating their own currencies, getting off SWIFT, creating BRICS. I mean, on a grand scale, macro, this doesn't look good where we're going.
No, it doesn't look good where we're going. It is very unfortunate. And, all of this was predictable and preventable. But unfortunately, nobody listened to me, or not just me. I wasn't the only person out there. And it's not that I'm so smart. I mean, you don't have to be a genius to understand these basic economic principles. Either the rest of the world was just that dumb, or they just didn't want to admit the reality because they were making so much money
in the short term,
fantasy
Yeah.
So look, there are a lot of reasons that stuff like this happens, but in the end, it's happening, and it's very scary. It's unfortunate, but I'm out here, and I hope a lot more people discover me, discover my podcasts, and get to understand that it was predictable. It isn't something that came out of left field like they claimed in the 2008 financial crisis, a 100-year
Hmm.
flood. It wasn't a 100-year flood. They opened up the spigots. I could see the water coming. And all the major problems that we have, I mean, I predicted them all. Student loan problems, or everything that we're going through. It's stuff I've been warning about for years. I wrote about. There are free market solutions to every government created problem. And I talk about, those solutions and those problems on the podcast.
Hmm.
And just, get some kind of critical mass of Americans to wake up
Do you have
and
hope?
understand. I mean, it's difficult.
Do you have hope that, I guess where I'm getting at is, do you have hope that that'll happen, that the world will look better for young people like Spencer? Will we get it?
Well, maybe some country will get it, and then you guys could all move there. It's like, so somebody's got to get it, is going to get it right. I mean, but the question is, will America get it right? I hope so. I mean, I'm still an American. I still kind of live in America, but so I hope the country, does well, and it's going to have to get bad, first. We've got a lot of sins to atone for, right? If we want to get to heaven. And so I hope we do, because the other direction is not going to look good.
Hmm.
You get to a totalitarian
Exactly.
society, and it totally breaks down.
Hmm.
And hyperinflation can give rise to some awful
Uh-huh.
forms of government, and that is the path that we're headed in
Yep.
if we don't do the right thing. So
Well,
I'm gonna hope for the best, but I don't plan for the best. I kind of plan for the worst, and I kind of invest. You know, so if the worst case scenario happens, my investors do well, but I think I'll do well regardless of what happens, because I don't see any outcome that doesn't lead to a much lower dollar than the one we have
Mhm.
now, a much higher gold price, and foreign assets way outperforming U.S. assets. I just can't see how we end up with anything other than that. And so I'm invested for that. But if we do all the right things, then one day I'll be able to invest completely in the United States. There'll be great bargains around, because when we do all the right things, U.S. stocks are going to be really cheap when that happens. And not that many people will have money to buy them, which is one of the reasons they'll be cheap. And of course, when the markets are at the lows, everybody is afraid to buy because they're worried they're going to go even lower. So
Mhm.
I'll have plenty of dry powder available to buy U.S. stocks if and when they get really cheap. And there's reason for me to hope that there'll be a turnaround. I mean, right now, I think U.S. stocks are still expensive, and nothing that we've done indicates that we're doing the right thing.
Well, Peter, it's always such a pleasure to
Right.
talk to you. Thank you so much. Any final thoughts, or what you want to leave people with, and where to send them?
No, just as I said, listen to my podcast, maybe become a client of my asset management company, and don't hold too much Bitcoin. If I mean, you don't have to sell
Great
everything. I mean,
entry
I
point.
would. I would sell everything, but at least sell something. Don't go down with this ship, right? Don't hodl to zero, because you're not going to be happy that you did that. I mean, you can say it now. Oh yeah, I'm in for the long run. I'm never going to sell. But people won't have that feeling, in a few years. It'll be like, God damn it, I wish I could have sold. I would have, could have, should have, right? If I only would have sold, yes. But instead of saying, if I only would have sold in a few years, just sell right now, and then you won't have to say that.
Well, we are a believer that free markets should prevail. So we'll see what the market says about Bitcoin. Peter, thank you so much.
All right, Natalie, take care.
Thank you so much for checking out this episode. I would love to hear from you. If you have any guest suggestions or feedback, make sure again that you're subscribed to this page and like the video so other people see it and you don't miss out on any new content. Until next time.